Hi grade 12s, I hope that you are well. And so today we're going to be doing our last video on companies, analysis and interpretation. So I spoke to you about what that is, what is interpretation, what are indicators. We spoke about why we interpret. I spoke to you about who needs our statements, and I spoke to you about how we interpret, right? So today I want to go over the specific areas of analysis one more time, and I want to tell you what will indicate what to you. So what shift will indicate what in a specific situation and a question that you might get in your examination. So we're going to start with profitability as our first area of analysis, right? So our profitability, the first indicator we're going to use is the gross profit on sales, which is also called a gross margin. What's very important to know is, even if you know the formula and you calculate correctly, if your answer is just a digit and has no percentage, days or ratio, if it doesn't show what the number indicates, then you can still get the answer wrong. So you can't just have 33. If it's not 33%, it's not correct. So it's also very important to note what value of measurement we're using. So now we've said the gross profit on sales is always a percentage, right? And the gross profit of sales can be analyzed in the sense that it indicates the percentage by which the selling price is greater than the cost price, right? So the decrease in this particular ratio will then show and indicate that there's pressure on the selling price as a result of competition between other companies as well. So that can be relevant in the comparison of ShopRite and Pick n Pay. That Pick n Pay may feel the pressure from ShopRite because of their prices and all of that, and so they will see a decrease in their gross profit on sales, right? Because more customers are going to ShopRite. Then it would also indicate a decrease, would also indicate an upward pressure on costs as a result of inflation or other cost factors. So in the same sense that inflation, we all know how inflation works. If petrol goes up, public transport goes up, private cost also goes up, because you now have to consider how much petrol money you need to be able to go through a whole month. And because of that, companies that have foodstuff delivered to them increase the prices of their products. And then as a consumer, you just see higher petrol, higher transport, higher prices for food. Everything just goes up. That's how inflation works. So that's also what would have happened if you see a decrease in your gross profit on sales. Another thing is the reduced selling price to sell product. So when you start to feel that pressure from competitors and you decide, okay, maybe if I decrease my price more than I should to be able to drag in more people, that will also result as a decrease in the gross profit margin, right? Then the next indicator we're going to look into is the gross profit on cost of sales. Just never mind this one, we're going to come back to it. So the gross profit on cost of sales, right? This is also called gross markup. I did say you should know by now how to calculate markup. If you do not, please go back and look into that. Right, so this also is a percentage, very important to note. This shows, right, so a markup on cost should equal a percentage, and if not, it should be a result, and it could be a result of, right? So if there's no percentage, it could be a result of shrinkage, right? Or it could be a result of products that are not correctly marked. It could be a result of theft and discounts. So there should be a percentage, and if there's a point where you cannot calculate the percentage, these reasons that I just listed would be why, right? That the gross profit on cost of sales means that if there's no percentage, some of these things could be happening. You could have had excessive discounts, so then you undervalued products. You could have had theft, then you didn't have some of the products. You could have had products that are incorrectly marked, where some products were maybe overpriced or underpriced or stuff like that. And then you could have had shrinkage of any kind. I suppose you can have shrinkage in customers, you can have shrinkage in the products, right? Then the next ratio that we're going to look into the next indicator we're going to use to calculate profitability is the net profit on sales. So net profit on sales. This too is a percentage. I'm not going to keep saying it, but very, very important for you to have and to know, right? And when we look into net profit on sales, we look into if the ratio is 10%, that means that for every 1 rand of sales, 10 cents is profit, right? Because we all know that 100 cents equals to 1 rand. So that's how we calculate it. So the faster the turnover, the greater the accumulation of 10 cents and the larger the ultimate net profit. So this is used to determine what is our percentage of net profit, and it basically can translate to, basically if you make 1 rand, our profit is then 10 cents. So if your net profit on sales is 20%, it means for every 1 rand that you receive, you are getting 20 cents extra as a profit, right? Then we're going to look into operating expenses on sales. This is also a percentage, right? So you will see that actually most and almost all of our profitability indicators are percentages, right? So it indicates how much of the sale prices end up as profit. And the trend is favorable if the profit is increasing or at least consistent. So this information is important to know, just as a pause and an interjection, is the fact that it's very important to know, because when they then ask you, calculate the net profit on sales, right? You know the formula, you calculate it, that's great. Now what's next? They'll then say comment or leave advice, or what should the company do to increase their net profit on sales? What should the company do in terms of to continue the trajectory of their net profit on sales? And so you need to know what it does, what an increase shows, what a decrease shows, so that you know how to advise when a specific indicator has a specific result, right? So we said operating expenses on sales is favorable if the trend is favorable if profit is increasing or at least is consistent, right? Then lastly, under, oh, my bad, actually, my mistake, I'm so sorry. So for net operating expenses, my bad, expenses on sales, this indicates how much of the sales price is used to cover running expenses. And the trend is favorable if this is dropping or at least consistent. You would never want the amount of sale price that you're using to increase, that you're using to cover your expenses. Then when we look, so it was also a percentage. Then when we look into operating profit on sales, we are then, yes, operating profit on sales. We're then looking into what I was saying before, that it indicates how much of the sale price ends up as profit. So it is also a percentage, and it is favorable when the profit is increasing and is at least consistent. Then the next ratios we're going to look into is the liquidity ratios, right? The liquidity ratios, namely, are the current ratio, the asset test ratio, the stock turnover rate, the stock holding period, etc, etc. We spoke about them in the previous video. If you missed it, go back and look at that one, right? So we're going to start with the fact that we all know a ratio is put in the form, you can see here, is put in the form of x is to y. So that is the measure, or that is the way in which it's being presented as an answer. So your answer can't be a percentage, your answer can't be in days for the current ratio, right? So the current ratio has a formula like all the other ratios, but it indicates whether or not the business can meet its short-term obligations. We discussed that the short-term obligations are obligations we can meet in the space of 0 to 12 months. And long-term ones are the ones that we can meet over 12 months. And it should not be too high, as it means that the funds are tied up instead of being used more effectively, right? So the current ratio indicates that. You'll see that in the questions, they'll ask you something like, it says, identify or state a ratio we can use to, in this case, identify whether the business can meet its short-term liability obligations. They won't say calculate the current ratio. You need to know that that's the ratio to use. Then when we move to the asset test, also note x is to y. So we'll get into the formulas in the next lessons, okay? And then when we look into the asset test ratio, this one, if it is too low, the business will not be able to meet its short-term obligations. So if it's total, so we're just going to realize that it's also a ratio, so it's x is to y. Fumble. It should not be too high, as that will mean that the funds are tied up instead of being used more effectively. So it is similar to the asset. The asset test ratio is similar to the current ratio, just has the difference of that, in the sense that the current ratio basically focuses on whether or not the business can meet its short-term obligations, and the asset test ratio does the same thing, excluding inventory, and that will make sense for you in the next set of lessons, right? Then we're going to look into the stock turnover rate, right? Turnover rate means how many times per period, and our financial period is always a year. So obviously our unit of measurement is times per year, right? So that's what we write at the end of our answer. So x times per year, times a year, right? And this basically is used to figure out, is stock turned over a number times its stock is turned over a number times a year. So it depends on the type of goods that are being sold. The business needs to always look into increase the sales, and in order to create a highlight rate stock turnover. So this turnover is basically about, okay, we have the products, we have what we are providing, what we are selling, right? How long does it take for us to materialize our stock? How long does it take for us to convert our stock from being inventory in our storage to being profit and money and cash in our business, right? So how long does that take? And obviously that can only be measured in the period of a year, so x times per year. Then we go into stock holding period. This is basically shows the faster the sales occur, the fewer the number of days stock is kept. Also almost similar to the turnover rate, but this is a holding period. So this calculates mostly on how long does the business hold on to specific inventory, and how long does it take for it to be distributed or to be sold. This is also influenced by the type of goods being sold as well. So it's measured in days, right? And then the average debtors collection. Let me just move that up for you so you can see. Average debtors collection period. This is in days as well. Anything that ends with period is in days, right? So the average debtors collection period indicates how long debtors will take to settle their accounts. It is informed by credit terms of the business. So you usually find a debtors collection schedule where you realize that the business has decided in the first 3 months customers should pay this percentage of their debt. In the next month they should pay this much, and the next month they should pay this much. So that is how it is determined. And then our average creditors payment period is also measured in days, and it indicates how long the business takes to pay its own creditors, its own debt, and it is informed by your creditor schedule as well, your creditors and the credit terms you have with the supplier that you agreed and took credit from. Yeah, so this is liquidity and profitability.